The number is $970 billion. That is what the United States paid last year just in interest on its own debt. Not to build schools, not to fund hospitals, not to repair bridges or feed families, just to service the interest on money it already borrowed. That single number, nearly $1 trillion, is now larger than the entire defense budget, and it is just the beginning. Because here is the truth that the headlines are not telling you. The 2008 financial crisis, the one that wiped out trillions in wealth, collapsed the housing market, and threw 9 million Americans out of work, was a contained explosion. One sector, one country at the center, one set of broken instruments called mortgage-backed securities. The system bent. It did not break. And the reason it did not break was because governments around the world could still borrow and print their way to a rescue. The Federal Reserve had room to move. Governments had room to spend. The cavalry could ride in. That safety net no longer exists. What is building right now is not a housing crisis. It is not a tech bubble. It is not a subprime loan collapse in one corner of Wall Street. What is building right now is a debt crisis at the level of the entire financial architecture, a sovereign debt reckoning across the world's most powerful economies, a slow-motion unwinding of 30 years of borrowed time, and this time, when the dominoes begin to fall, there is no government big enough, no central bank powerful enough, and no tool left in the arsenal to stop what comes next. This is the story of why the next global financial crisis will not just be different from 2008. It will be categorically worse. We are going to look at data, the history, and the structural rot underneath the surface of the global economy. And by the end, you will understand exactly what is happening, why it matters to you personally, and what the people who survive these moments do differently from everyone else. 3 collapses. To understand where we are going, you have to understand where we have been, because every major financial collapse of the last 100 years has followed the same pattern. Excess builds slowly. Warning signs are ignored, and then one day, the thing that everyone said could not happen happens. In 1929, the excess was in the stock market. Ordinary Americans were buying equities on margin, borrowing 90 cents of every dollar they invested. The underlying companies had not changed. The real economy had not suddenly become 10 times more valuable. But on paper, wealth was multiplying. Then the music stopped. The Dow Jones Industrial Average lost nearly 90% of its value between 1929 and 1932. Unemployment in the United States, 25%. The Great Depression was not just a financial event. It was a social catastrophe that reshaped the entire political order of the Western world. In 2008, the excess was in real estate. Banks had figured out how to package bad mortgages into financial instruments so complex and so opaque that even the people selling them did not fully understand what they were holding. The rating agencies gave these toxic bundles the highest possible safety scores. Institutions all over the world loaded up. When housing prices stopped rising and started falling, the entire structure collapsed. Bear Stearns, Lehman Brothers, Egg, Washington Mutual. Banks that had existed for decades wiped out in weeks. The government had to intervene with trillions in bailouts, guarantees, and emergency lending programs to prevent a total seizure of the global credit system. Even so, $10 to $15 trillion in global GDP was destroyed. Recovery took years. In some communities, it never fully came. Now we are entering a third era, and this one is different in the most fundamental way possible. Because in 1929, the excess was in stocks. In 2008, the excess was in housing. But today, the excess is in the thing we use to rescue ourselves from the previous 2 crises. The excess today is in government debt itself, $251 trillion weight. Let us talk about the numbers. Not in a way that is abstract or theoretical, in a way that lands like a punch to the stomach. Total global debt, public and private combined, now stands at $251 trillion according to the IMF's latest global debt database. That represents more than 235% of everything the entire world produces in a year. Every single country, every single factory, every single harvest, every single service rendered. Multiply it by more than 2. That is still less than what humanity owes. And that number, as staggering as it is, masks the most dangerous part. The split between public and private debt has changed dramatically. Private debt has actually been falling. Companies and households are paying down what they owe. But government debt is rising. Global public debt has now climbed to nearly 93% of global GDP. The IMF has projected that it could surpass 100% of global GDP by 2029. the highest level since 1948 in the shadow of World War II. Think about what that means. In 1948, the world had just finished the most destructive conflict in human history. Governments had borrowed to build armies, produce weapons, and fund battles across continents. That was the last time the debt burden was this heavy. And even then, the world had an enormous growth boom waiting on the other side. Rebuilding, manufacturing, a surge of productivity that gave governments the room to pay down what they owed. Where is that growth boom today? In the United States specifically, the numbers are so extreme they barely seem real. The national debt crossed $38 trillion in October 2025. The annual interest payment on that debt has now surpassed $1 trillion for the first time in American history. $1 trillion every single year, just in interest. Not a penny of that pays down the debt itself. Not a penny builds infrastructure or funds research or educates a child. It just services the cost of previous borrowing. To put that in perspective, the United States now spends more money on debt interest than it does on national defense, more than it spends on all non-defense discretionary programs combined. Education, law enforcement, scientific research, environmental protection. All of it, combined, costs less than the interest bill. And it is accelerating. The Congressional Budget Office projects that interest payments alone will hit $1.5 trillion annually by 2032 and $2.1 trillion by 2036, just 16 years away. Under more pessimistic projections, accounting for the legislation already passed in 2025, that figure could reach $2.2 trillion even sooner. America is mathematically locked in a debt spiral. You borrow more to pay the interest on the debt. The new borrowing adds the total. The total generates more interest. The interest requires more borrowing. The cycle does not end on its own. This is not a warning about some distant hypothetical. This is the 2026 reality. And the United States is not alone. A world built on borrowed ceilings. Across the entire developed world, the story is the same. Japan carries public debt equal to 230% of its GDP. The highest government debt to GDP ratio of any major economy on Earth. Greece, despite years of brutal austerity, still carries debt at 147% of GDP. Italy stands at 137%. France and the United Kingdom are not far behind. The IMF has identified that countries representing 80% of global GDP now carry public debt that is both higher than before the COVID-19 pandemic and rising at a faster pace. This matters because of something the OECD flagged. 42% of all global sovereign debt is set to mature by 2027. That means nearly half of all government bonds sold around the world need to be rolled over in the next 2 years. Refinance. New buyers must be found. New interest rates must be accepted. And those interest rates today are dramatically higher than when most of that debt was originally issued. Governments borrowed cheaply for over a decade after 2008. The era of near zero interest rates made debt almost free. A government could borrow $1 billion and pay almost nothing in interest. That era is over. Rates are now significantly higher. When that maturing debt gets rolled over at modern rates, the interest bills explode. The OECD is watching this happen in real time and calling it one of the central fiscal risks of the decade. Meanwhile, the developing world is facing its own version of this crisis, possibly even more severe. Low- and middle-income countries recorded $741 billion in net external debt outflows between 2022 and 2024. Meaning they paid out $741 billion more in principal and interest than they received in new financing. That is the largest net drain on the developing world in 50 years. Bilateral lending from governments has fallen to its lowest level since the global financial crisis. Private lenders are pulling back. The capital that once flowed toward growth is now being suctioned back toward debt service. When developing economies cannot borrow, they cannot invest. When they cannot invest, growth stalls. When growth stalls, tax revenues fall. When revenues fall, they borrow more or default. This is the liquidity trap playing out not just in one country, but across dozens simultaneously. Why this time there is no rescue? Here is the single most important difference between 2008 and what is building now. And it is the thing that makes the next crisis categorically more dangerous. When Lehman Brothers collapsed in September 2008, the response was immediate and overwhelming. The United States Treasury launched the Troubled Asset Relief Program. The Federal Reserve slashed interest rates to essentially zero and began purchasing trillions in government bonds and mortgage securities, policy called quantitative easing. The government deficit exploded, spending far more than it collected in taxes, pumped demand into a frozen economy. Governments across Europe did the same. China unleashed a stimulus program worth hundreds of billions of dollars. The combined firepower of global governments and central banks was enormous. And it worked, imperfectly, unequally, with enormous long-term costs, but it worked well enough to prevent total systemic collapse. Those tools are not available in the same way today. And this is the core of why what comes next will be worse. The Federal Reserve cannot cut rates from a comfortable position because it has spent the last several years raising them to fight the highest inflation in a generation. It has limited room. More importantly, the United States government cannot simply borrow its way out of the next crisis the way it did after 2008. It already starts this crisis cycle with debt at 100% of GDP, higher relative to the economy than at any point since World War II. The fiscal space to respond, according to the American Action Forum, has shrunk to just 6% of GDP and is projected to virtually disappear by 2029. In plain language, the government's ability to run emergency deficits to rescue the economy is almost gone. The financial buffer that saved us in 2008 was built in decades of relative fiscal discipline. It was spent in response to the global financial crisis and then again in response to COVID-19. We are now trying to defend a castle whose walls were dismantled to fight the last two battles. At the same time, credibility of the institutions meant to manage this crisis is under pressure in ways it was not in 2008. The Federal Reserve's reputation as an independent, effective guardian of financial stability has been complicated by a decade of policies that may have sown the seeds of the very instability we now face. Governments that were supposed to restore fiscal discipline after 2008 instead piled on trillions more in new obligation. The SIBO's February 2026 baseline now projects $26 trillion in additional deficits over the next decade, not historical deficits. New ones, projected, baked in. Every major financial collapse in modern history has been preceded by warning signs that were visible in advance and ignored by almost everyone. Here are 5 that are flashing right now. The first is concentration. In 1929, a handful of glamour stocks dominated the market and amplified the crash. In 2000, the top technology names became the entire NASDAQ bet. Today, the top 7 companies in the S&P 500 represent more than 30% of the entire index. Buying a broad market fund today is, in practice, a concentrated bet on a tiny group of companies. When those companies stumble, and eventually every company stumbles, the impact on the wider market is magnified by the concentration. The second is the speed of modern bank runs. In 2023, Silicon Valley Bank was the 16th largest bank in the United States. When concerns about its balance sheet became public, the bank did not fail slowly. It failed in hours. Customers, many of them technology firms communicating through group chats and messaging platforms, pulled their deposits faster than has ever been seen in banking history. $42 billion in a single day. That was a regional bank. Apply that speed to a major global institution, and the dynamics become almost impossible to manage with traditional tools. The third is the hidden fragility in commercial real reality. Banks across the United States and Europe are sitting on enormous portfolios of commercial real estate loans, office buildings, shopping centers, hotels that were financed in an era of low rates and pre-pandemic assumptions about how people work and spend. Those assumptions are no longer valid. Vacancy rates in commercial office space in major American cities are at historic highs. The value of those properties has collapsed, but the loans against them have not been fully written down. The losses are real. They are just not recognized yet. The fourth is the dollar fragmentation. BRICS countries, Brazil, Russia, India, China, and South Africa, now joined by others, have been visibly reducing their holdings of U.S. Treasury securities. China has cut its Treasury holdings nearly in half over the past decade. Brazil reduced its holdings by 27% in a single year. This is not panic selling. It is a deliberate, structural repositioning away from the dollar as the unquestioned foundation of global reserves. Gold's share of central bank reserves just surpassed the U.S. dollar share for the first time. That is not a trivial statistic. That is a signal about what the world's governments believe is coming. The fifth is the derivatives market. The total notional value of global derivatives contracts, financial instruments whose value is derived from underlying assets, is measured not in trillions, but in hundreds of trillions. These instruments link financial institutions around the world in a web of obligations so complex that in a genuine crisis moment, no one can fully map out who owes what to whom. In 2008, derivatives on mortgage-backed securities created contagion that regulators did not see coming. Today, the derivatives market is larger, more interconnected, and in some areas less well-regulated than it was before 2008. When a system with these 5 characteristics encounters a genuine shock, the failure is not linear. It is exponential. The hyperinflation trap and the currency question. There is one final mechanism that makes the next crisis potentially more severe than anything in modern history, and it is the mechanism that most people do not understand until it is too late. When a government finds itself unable to borrow enough to cover its obligations, it faces a choice. It can default, tell its creditors it cannot pay. Or it can print. In modern economies with their own central banks, printing is always the path of least political resistance. You do not have to tell your citizens you failed. You just quietly inflate away the debt. Reduce the real value of what you owe by reducing the real value of the currency it is owed in. This is the path the IMF is already watching with concern. Multiple institutions have flagged that persistent high deficits combined with rising debt costs increase the probability of fiscal dominance, a situation where the central bank effectively loses its independence and begins monetizing government debt regardless of the inflationary consequence. That is the technical term for the process that produces hyperinflation in its most extreme historical cases, in Weimar Germany in the 1920s, in Zimbabwe in the early 2000s, in Venezuela in the last decade. None of these economies began their inflationary spirals thinking they were heading for catastrophe. They began with a deficit problem, with borrowing costs that exceeded their ability to pay, with a political choice to print rather than default. The debt got inflated away, but so did the savings of every ordinary citizen who trusted their currency to store value. This does not mean hyperinflation is the guaranteed outcome in the United States or in Europe. These are not structurally equivalent situations, but it does mean that the policy space available to navigate a major financial shock without severe inflationary consequences is far narrower than it was in 2008. The room has been eaten. What history teaches about survival. Every time a major financial order has collapsed or reset, there have been people who saw what was coming and positioned themselves accordingly. And every time their common denominator was not prediction of the exact timing. It was understanding the structure of what was happening well enough to take protective action before the panic. In the 1920s, the investors who survived 1929 were not those who called the exact date of the crash. They were those who had grown uncomfortable with the leverage in the system and had quietly reduced their exposure to it. In 2007 and 2008, the hedge fund managers who made fortunes were not necessarily smarter than everyone else about the direction of housing prices. They simply asked a structural question. What happens if the assumptions underlying these instruments are wrong? And when they ran that analysis, the risk was obvious. What does the structural analysis say right now? It says that governments with debt at 100% of GDP and annual deficits running at 6 to 7% of GDP cannot continue this path without a resolution, either through growth, through austerity, through inflation, or through some form of restructuring. There is no fourth option. It says that a financial system where 42% of sovereign bonds need to be refinanced at higher rates within 2 years is undergoing a stress test unlike anything since the late 1940s. It says that markets where 7 stocks represent a third of all value carry concentration risk that is not priced in to most portfolios. The appropriate response to this structural reality is not panic. Panic is the enemy of good decision-making in crisis conditions. The appropriate response is to think clearly about the difference between assets that hold their value in a deteriorating monetary environment and assets that do not. Physical assets, real property, productive land, businesses that generate actual cash flow from real goods and services tend to hold value across monetary regime changes in ways that paper assets do not. Throughout history, from the collapse of the Roman Empire's currency to the post-war inflations of the 20th century, Tangible ownership has been the anchor that kept wealth intact while paper claims eroded. Precious metals, specifically gold, have served as the default hedge against currency debasement for thousands of years. There is a reason central banks around the world are buying gold at the fastest pace on record. They see what is coming. They are acting on it. Gold's 53% rise over the prior year and a half through late 2025 is not coincidence or speculation. It is the market pricing in a fundamental shift in confidence about the long-term value of paper money. Diversification across currencies and jurisdictions, reducing your exposure to the specific risk that any single government's fiscal crisis blows up its currency, is another tool that sophisticated investors have used throughout history to protect wealth across political and economic disruptions. None of this is about becoming a doomsday prepper or betting against civilization. It is about understanding that financial regimes change. They always have. The Bretton Woods system that governed global finance from 1944 changed in 1971 when Nixon took the dollar off the gold standard. The system that emerged from that change had its own rules and its own vulnerabilities. Those vulnerabilities are now, 70 years later, reaching their natural terminus. The next system is being built. We just do not yet know its exact shape. The moment clarity. Here is the thing about every major financial crisis in history. In retrospect, the warning signs were obvious. The numbers were there. The analysts had written the reports. Stress tests had flagged the vulnerabilities. But human psychology, the tendency to extrapolate the recent past into the future, the desire to believe that stability is permanent, the social pressure to not be the person who raises the uncomfortable question overwhelmed the analytical signals. In 2006, a handful of economists and investors looked at the mathematics of the housing market and concluded it was not sustainable. They were ridiculed for years before they were vindicated. In 1928, a number of voices raised concerns about the leverage in the equity market. They were dismissed as pessimists while prices continued to rise. We are at that moment again. The mathematics of sovereign debt is not sustainable. The path from $970 billion in annual interest payments today to $2 trillion within a decade while adding new debt every year is not a path that ends in stability. The sovereign bond refinancing wall of the next 2 years is not a minor technical issue. The hollowing out of fiscal space across the world's major economies is not a theoretical concern. These are structural realities. The next global financial crisis will not be worse than 2008 because the world is more pessimistic or because financial regulators are less competent. It will be worse because the tools we used to manage 2008 have been exhausted in managing 2008. The debt that saved us then is the threat that confronts us now. You are watching in real time the final chapter of a financial era that began in 1971 and borrowed its way through every obstacle it encountered until it ran out of road. What comes next will be painful for those who do not see it coming. For those who do, who understand the mechanisms, who make clear-headed decisions about the difference between real wealth and paper promises, this moment, like every great transition in financial history, will also contain within it the seeds of the greatest wealth transfer of a generation. The question is not whether you believe this is coming. The mathematics does not require your belief to operate. The question is only whether you are paying attention while there is still time to act. The numbers are there. The pattern is there. The history is there. Now you have to decide what you do with it.